After hitting an all-time low of 461 at the end of 2022, SoFi stock has more than doubled, closing at a high of 1032 at the end of 2023. But since then, the stock is down more than 35%, and a large investment fund sold a huge stake in the company while the CEO is loading up. So who's right? Let's dive in and find out. Okay, 3 points that we are going to cover in this video. Number one, the business model. What does the company do? So SoFi is short for social finance. They're a one-stop fintech shop with multiple financial products from loans to credit cards and investing options. Think of a place where banking and technology meet. Number two, the opportunity, positives and negatives. The stock has experienced a lot of volatility since its IPO in early 2021 and had to navigate a 22x increase in interest rates going from quantitative easing to quantitative tightening. And it made it out alive. But some investors threw in the towel while the CEO believes in the long-term vision of the company. Number three, the valuation. On Wall Street, we build three-statement financial models culminating in a DCF valuation. I have built a three-statement model for SoFi, and I can't wait to give you all the details. So let's dive right in. All right, part number one, the business model. So background of the company was founded in August 2011 by students from Stanford Business School focused on an alumni-funded lending model. In 2015, it became the first US-based fintech company to receive a $1 billion funding round. In January 2020, the company celebrated reaching 1 million members, and in early 2021, the company went public under the ticker SoFi, S-O-F-I. Now, the company says that its mission is to help people reach financial independence to realize their ambitions. And their number one goal is helping their members get their money right. They refer to their customers or clients as members. Now, the bank business is a borrow short, lend long business, which means that banks use our short-term deposits, which they borrow at a very low rate, let's say 1%. They make long-term loans, say on a 30-year mortgage, at a higher rate, let's say 7%. So in this example, they earn a spread of net interest of 6%, the 7% that they lent it out at, the 1% that they're borrowing it at. Now, the company has three reportable segments. Number one, lending. Lending consists of personal loans, student loans, and home loans. So personal loans range from $5,000 to $100,000, 2 to 7 years in duration, and they're typically for home improvements and debt consolidation. Student loans, they actually operate primarily in the refinance space, 5,000 or higher in the 5 to 20-year range. And lastly, home loans from 75,000 to almost 800,000 in size, up to 1.15 million, depending on the high cost area, and standard loan offerings that you would typically expect to receive, 30-year fixed, ARMs, etc. Now, SoFi, interestingly enough, focuses on packaging these loans via securitizations. So they're not holding these loans in the long term. This frees up capital to make more loans. So you might be thinking, wait, how do they make money then? If you've ever received a loan of any type for a home, a car, etc., the fees can range from 5 to 10% of the loan value, depending on the size. And that is where they make their money, not in receiving interest and principal payments. Number two, their technology platform. So SoFi provides a cloud-based platform that includes payment fraud mitigation and AI-based virtual assistants for financial services firms in North and Latin America. Think of a third-party outsourcing of a financial services platform on a license fee basis. They actually refer to this as BaaS, B-A-A-S, banking as a service. Lastly, the third reportable segment, financial services. So this consists of SoFi Money, which is digital checking and savings accounts with competitive interest rates, access to expanded FDIC coverage up to $2 million. They also have debit cards, and they offer ACH, check, and wire transactions. Then there's SoFi Invest, which is a mobile-first investment platform offering trading and advisory solutions, including active and robo-investing options. They also offer options trading, pre-IPO shares, fractional shares like Robinhood, and the use of margin, which is leverage. Lastly, SoFi also offers cashback credit cards, personal financial management, insurance, and even a way for employers to pay their student loans of their employees. Now, as a financial services firm, the company is subject to way many regulations, more than a typical average company, over 40 in fact. Now, these range from Dodd-Frank for banking and SEC and FINRA regulations for securities. Now, while this is a very competitive space, SoFi is focused on younger customers accustomed to technology, and they also have a focus on ESG and inclusiveness through internal initiatives focused on helping women, veterans, and underrepresented minority groups. Part two, the opportunity, positives and negatives. I'm going to start with the negatives first. So very recently, couple weeks ago, the Qatari investment fund sold its entire stake in SoFi, 19.8 million shares at an average price of 678, which obviously makes other investors leery/hesitant. But the CEO bought more shares, almost 31,000, at an average price of 648, bringing his total holdings to 8.12 million. Now, Peter Lynch, famed investor of the Fidelity Magellan Fund, famously said, there are many reasons why someone might sell a stock, but there's only one reason that you buy a stock. That's because you think it's going up. So the company does not have a long track record as a public company, and it's in a supernormal growth phase, which means it's very difficult to project the financials because we do not know what the steady state growth rate will be and when it will be achieved. We've seen this previously with Nvidia. 70% of its loan book are personal loans, which are unsecured. And if there's softness in the economy or a recession, there will be delinquencies that can have a significant negative impact on revenues. Now, in early 2021, the stock increased over 30% within less than a month of the IPO, reaching the mid-20s, but it has floundered since, and investors want to know, when is it going to turn the corner? All right, next we have the positives. The company is in a rapid growth phase of business. The stock has already really taken a beating, so it might provide a good entry point. We'll see this next in the valuation. While I mentioned earlier that the company hit 1 million members in January of 2020, 4.5 years later, it has 8 million members. This is absolutely incredible. The average quarterly growth in members is 10% over the last 8 quarters. So going from one quarter to another, 10%. And then year over year growth has averaged 53% over the last 8 quarters. In terms of acquisitions, the company acquired Golden Pacific Bancorp and Technisys early in 2022, and this provided new income streams for the company, helping it to diversify its revenue beyond the student loan space where they started. The Technisys acquisition in particular provides a lot of option value for the company as they're focused on offering banking as a service. So I mentioned this before, BaaS, BaaS. Think of Amazon Web Services, but for finance. The company does need to be careful not to do too many acquisitions too quickly because it may distract them from focusing on organic growth. If you're enjoying this, please smash that like button. Part 3, the moment we've all been waiting for, the valuation. So for a bank/fintech company which came public right at the beginning of COVID and then experienced over a 20 times increase in interest rates in 18 months, after being a bank for a very short time frame, the company has shown incredible resilience. All right, so let's touch on the balance sheet. So a few major points here. SoFi has had a 3-year increase in cash of 2.7x. Loans held for sale has had a 3-year increase of 3.2x. Remember, they securitize their loans, they package them for sale, which indicates the growth in loan volume. In February of 2022, SoFi closed on the acquisition of Golden Pacific Bancorp, a bank holding company, which is why $7.3 billion of deposits appears on the balance sheet in that time frame. Now, we're also going to see this later on in the cash flow statement. So the deposits have increased 2.5x year over year. So that banking business is growing very significantly. So what's the takeaway? In the last 3 years since going public, book value, a key indicator of bank health, has gone from minus 120 million to positive 5.2 billion, which shows they're on the right track. Let's hop in the model. Okay, balance sheet, y'all. So 3-year growth in cash, as I mentioned, 2.7x. Loans held for sale has had a significant increase. That's the loans that they securitize and sell off. Deposits right here, 2.5 times increase. And then the equity, as I mentioned, went from negative 120 million to positive 5.2 billion. Okay, next we have the income statement. Revenue growth is increasing at a decreasing rate, achieving a 3-year average of 55%, which works out to be a 3.7x increase. Gross margin, which is an indicator of profitability relative to the cost of sales, has increased from 71% in 2020 to 83% in 2023. This shows that revenue growth has significantly outpaced the growth in costs. Lastly, EBITDA, which is a proxy for cash flow, turned positive for the first time in 2023, which is a massive win. So what's the takeaway? Everything is headed in the right direction and there's huge positives, but it makes it very difficult for the company to value with a limited track record. Let's hop in the model. All right, so as I mentioned, a 3.7x increase in revenue over the last 3 years, just truly remarkable. Gross profit is growing significantly. EBITDA turned positive for the first time in 2023. But as you can see, if we go down below, still negative on the net income side and only turning positive in 2023, which means that they still don't have a ton of stability with such a short time frame being public. Next, we have the cash flow statement. Normally, we see positive operating cash flow and negative negative cash from financing, but with a financial services company, it's the opposite. And that's because assets are liabilities and liabilities are assets. So what that means is normally a deposit that we make is an asset to us, but it's a liability to the bank. Normally a loan for us is a liability because we have to pay it, but the bank receives it. Now, despite large acquisitions in 2022, the company managed to create 2.8 billion in cash, which is truly remarkable. The company is projected to generate 1.6 billion of cash in the next 5 years. So what's the takeaway? The company has positive momentum and needs to continue to leverage its success as it integrates its recent acquisitions. Let's hop in the model. All right, so remember with banks, liabilities are assets, the assets are liabilities. So loans held for sale, those are increasing, but because they're assets, it's a big cash outflow. This is why we see that negative cash from operations. On the flip side, though, we see these deposits right here. Those are increasing significantly. Those are liabilities. So an increase in a liability is an increase in cash flow. Increase in an asset is a cash outflow. But net, what we see is the cash from operations plus the cash from investing plus the cash from financing, we end up seeing significant cash increase and creation to the tune of 2.8 billion over the last 2 years, which shows that they're going in the right direction. They're heading on the right track. Okay, next, forecast drivers and DCF assumptions. So long-term top-line revenue growth is in the mid to high teens. All costs are headed in the right direction. They're decreasing as a percentage of sales. As we mentioned earlier, EBITDA was positive in 2023 with a margin of 7.1% and is projected to more than double that margin to 15% in the projected years and continuing throughout. Now, the company does not have a credit rating, but doing a weighted average cost of debt, it comes to about 6.46, which puts them in the double B or junk territory, which means they're sub-investment grade. This makes it challenging to raise capital at low rates, and hopefully they can improve this going forward. Another thing to note, they have a very high beta of 1.75. That's indicative of a very risky company. And that's a big warning here. The variance in value is going to be pretty wide. We're going to see this next in the DCF valuation. So what's the takeaway? Conservative assumptions are going to give us conservative results. Let's hop in the model. So as I mentioned, costs are headed in the right direction. You see going from 33% to 22%, 45 to 31.5, 29 to 16.6. So you can see all the costs as a percentage of sales are on the decline. As I mentioned, beta 1.75, pretty high, something that we should keep an eye on and watch out for. That results in a pretty high cost of equity, 11.5%. We come down to the weighted average cost of capital here. 70% of their capital structure is equity, 30% is debt. So we get a WACC of 9.6%, which is a little bit on the higher side. As we move down here, one of the things that I do want to touch upon is the terminal revenue multiple. Now, we've talked about this in previous valuations. The terminal multiple is the multiple of an underlying metric. In this case, we're going with revenue. And that multiple is going to be multiplied by that metric at the end of the model. So in this case, revenue, we're going to go with 3 times revenue. What that signifies is the value of the company from the end of the model all the way out into infinity. Now, here's the issue. If we look at the comps, as you can see here, it's a very wide range. It goes from 0.1 times to 7 times. So we get a mean of the comps of 3.3 times. We went with 3 to be conservative, but still, this is a very, very wide gap. What we're going to do is we're going to fix that when we get to the data tables and sensitize it later on. We're going to be able to actually see that range of terminal multiples and the impact that that has on the ultimate valuation. Okay, DCF valuation. So we ran 3 scenarios, a bear case, a base case, and a bull case with the current model at base. What we're doing with a financial model, particular a DCF, we're taking future cash flows, we're discounting them back to today to get to TEV or total enterprise value. We strip out net debt, that gives us equity value. The company is a very high growth company, it has lots of cash and upside potential, but is it worth buying today? The stock is down 33% year to date. Wall Street has SoFi at a median value of $9, which is a 39.5% discount. But what does our analysis show? Let's hop in the model. Okay, so standard DCF model here, we start with EBITDA, we strip out DNA to get to EBIT, strip out the cash taxes, that gets us to EBI. We add back the DNA, we take into account changes in operating working capital, which is current assets excluding cash, current liabilities excluding short-term debt, then CapEx. We see that the first year, the free cash flow to the firm is actually negative. It turns positive later on. We have the terminal value, remember that 3 times revenues right here. We have the cash flows that we're going to discount. We multiply it by the discount factor, which is the value of those future dollars in today's dollar terms. We get the present value of the cash flows, which is going to lead us to our total enterprise value. We strip out debt, we add cash, we strip out non-controlling interest, as well as redeemable preferred stock, which the company has. We add associate investments. We end up getting an intrinsic equity value of $10.6 billion. Based on the shares outstanding, that gives us an implied share price of 10.03. With the recent close of 645, that's almost a 56% discount, which is definitely a buy rating. Okay, next, sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth and CapEx intensity, WACC, and the terminal multiple. Now, 5 out of 50 or 10% said sell, 5 out of 50 or 10% said hold, 40 out of 50 or 80% showed a buy rating. We ran each of the three scenarios equally weighted. We got a weighted average value of $10.22, which is a 56% discount. So what's the takeaway here? Utilizing conservative assumptions, we show a screaming buy rating for the stock with a very massive discount. Let's hop in the model. Okay, sensitivity analysis. What we did was we ran two data tables. What you can see here is tons of green, which is what we like to see. The thing that I talked about earlier, the terminal multiple, I'm not super confident in this 3 times revenue multiple, but what we did was we did a range based on the comps from 1 to 5. Now, if it's as low as 1, we actually get a sell rating. And as 2, we get a hold rating. So again, if you're more inclined to say that there's a downside likelihood higher than an upside, then you're in this range right here. So something to think about and consider. But overall, we show screaming buy across the board. Okay, coming down to our scenario analysis, again, we equally weighted each of the scenarios, bear case, base case, and bull case, 33.33% for each. We get a sell in the bear case, so about $1 discount from where we currently are. The base case, as we talked about earlier, 10.03. The bull case, massive upside, $15.18. We get a weighted average of 10.22, which is a 58% discount. And again, another massive buy rating. The one thing that I do want everybody to focus on here, though, is look at that variability, right? You could go down 5, up 5, and where we currently are, the upside is much higher, much significantly higher than the downside. But again, there's a lot of variance here. So just something to take into consideration. Okay, the wrap up. So Wall Street has SoFi at a median of $9 with a high of 13, which is a 102% discount, and a low of $4, which puts the stock at a 61% premium. The stock has shown massive volatility, going from an all-time high of over $25 within a month of its debut to losing more than 74% of its value over the next 3.5 years to close at 645 as of yesterday. You should seek the advice of an investment professional always. Now, I do not have a position in SoFi, but it is a compelling investment opportunity. Banks in general don't really get me excited from an investment perspective, and there's a massive range in values for this company. From down $1 to up $10, it does appear that the upside potential far outweighs the downside by 10x. This is a very promising company with a growing market penetration in a very competitive space. And it's a very interesting value proposition for its customers. FinTech's only going to continue to grow as time goes on, and SoFi continues to innovate, and they will experience success for years to come. If you like this and want to see another compelling stock valuation, check out my Albertsons model here. And if you found this valuable, please share this with someone who you think would enjoy this. And as always, be relentless.